Just a second. So that day we discussed from here. We discussed till here, correct? All of you, please. Hello.
Yes, sir.
Yeah, we discussed till date of exclusion, inclusion or exclusion. Am I right? Till here? No, I think we discussed till here. Uniform accounting policies. Fine. See, date of inclusion or exclusion is as per the IFRS 10. The date of acquisition is the date on which the investor obtains control of investee. Control is nothing but when a parent acquires a subsidiary, correct? Stakes in subsidiary. And date of disposal is when they lose the control. That means when they sell their stakes in industry or subsidiary. Once an investment is no longer a subsidiary, it should be treated as an associate as per IAS 28. That means that provided the condition is the investment should be between 30 to 50%. But if investment is below 30%, then it will be general investment. Okay, that's what. Now, accounting for subsidiaries and associates in the parent separate financial statement. See, a parent company will usually produce its own single company financial statements, and these should be prepared in accordance with International Accounting Standard 7 revised separate financial statements. In these statements, investments in subsidiaries and associates included in the consolidated financial statement should be either, that means if both the companies are preparing separate set of books. So what is that? Again, I will repeat. A parent company will usually produce its own single company financial statements, and this should be prepared as per this, that is separate financial statements. In these statements, they have to definitely account for their investments, what they have done. So investments in subsidiaries and associates included in the consolidated financial statement should be either shown at cost or in accordance with IFRS 9, that we will be seeing in chapter 11. That is nothing but accounting for investments. Okay, so don't worry, we will discuss about accounting for investments in the chapter number 11. But what they want to explain you here is, if separate set of books are maintained, if this particular parent company prepares a separate financial statement, whatever investment they have done, they have to definitely show that in their books. Okay, so they have to show what investments they have done in the company, either in subsidiary or associate, and they should, which they are going to include when they will consolidate at the end of the year. But before that, they are showing it separately. Now they are maintaining separate statements, so they should show these two companies in their balance sheet at cost, or it depends, like whether at amortized cost or market value. That we will decide or discuss when we'll be doing the chapter like financial instruments, actually financial instruments or accounting for investments. But as per the reporting standards 9, it is called financial instruments. So when we'll be dealing with that chapter, we'll be seeing how that can be accounted, in what ways. And when you sell, you should first classify it as held for sale and then sell it. Okay, without that you cannot directly sell. Then definitely the disclosure column. See, every standard what you are going to study in this reporting book, 3 things you are going to learn every time. First is recognition criteria. That is, if I tell you property, plant and equipment, if I give you this word and ask you, where are you going to show this? You will definitely tell me, sir, I'm going to show this in the balance sheet. I'll ask you why. Why? Because property, plant and equipment matches with the definition of asset. So when it matches with the definition of asset, the recognition criteria is almost done there. Second, measurement basis. That is how to measure it, either measure at cost or market value. Okay, market value in IFRS, they generally don't use this word. They use like realizable value, okay, or they use this word called value in use. So these all will be studying in chapter number 1 after consolidation. Don't worry. As far as like right now, you consider cost or market value, fair market value, like that. Okay. Third is disclosure requirements. So what I mean to say here, how to recognize a asset, how to measure it, and how to disclose or what to disclose regarding that asset. So disclosure is nothing but what you cannot show in the face of the statement, you have to show in the footnotes. And there, the footnotes, with footnotes, I mean disclosures. Okay. Now, so now when so disclosure is nothing but some extra or additional information which we cannot give on the face of the statement, that we should give in the footnote. So here let us see what are this. Disclosure, individual financial statements. So where a parent chooses to take advantage of the exemptions from preparing consolidated financial statements or under the separate financial statements, they must disclose. They must disclose. If they don't want to consolidate and they want to show separate statements, they want their subsidiary to show separately, show it as a separate entity and themselves. The fact that financial statements are separate financial statements, that the exemption from consolidation has been used, the name and the country of incorporation of the entity whose consolidated financial statements that comply with IFRS have been published, and the address where those consolidated financial statements are obtainable. That means you're showing them as separate. The fact that the financial statements are separate financial statements as per this, that the exemption from consolidation, that means you have used that special clause of exemption. The name and the country of, so where the company or the parent has got incorporated, which can prepare the consolidated statement, that you should disclose. And whether you are complying with IFRS or not, you have to show. And address where those consolidated financial statements, if at all they make it, are obtainable, that you should disclose. Then list of significant investments in subsidiaries. You should show what investment you have done in subsidiaries, like, or to what extent, whether you have given your land or property or resources to this. Then jointly controlled entities and associates. So you should always disclose what bigger investments you have done in all this, which cannot be ignored. That's the reason why, which cannot be ignored to be disclosed. That's the reason why we say it as significant investments, including the name, country of incorporation, proportion of ownership, interest, and if different, proportion of voting power held. So what you have in that company, what stakes you have in that company, you should disclose. Description of method used to account for investments listed under B. So here we'll see. So when a parent prepares separate financial statements in addition to consolidated financial statements, they also do this. See, some companies, they directly consolidate at the end of the year. They don't go for separate, but some they maintain separate as well as consolidation. The separate financial statements must disclose the fact that the statements are separate statements and the reasons why they have been prepared if not required by law. So why they do that? Reason should be given if law doesn't require them to do that, and information about all the investments whatever they have. Now, next point what we are going to discuss is content of group accounts and group structure. See, when you go for consolidation, the parent has to prepare all the statements. What are they? Consolidated statement of financial position, consolidated statement of profit or loss and other comprehensive income, consolidated statement of cash flows. These three they have to prepare. So we will definitely study about the financial position thing afterwards. As far as I know, you definitely know a normal format of a balance sheet as well as the income statement, which we have already seen in the ratio analysis chapter. Correct? All of you, please tell me yes or no.
Yes, sir.
Yes. So this and this you need to prepare. Cash flow statements, I've already given the video to you to go through, and some of the students are having doubts, so we will go for that. Don't worry. And consolidated statement of profit or loss, how to do the consolidation, we'll be seeing in the coming chapter. And
So,
yes,
consolidated statements of cash flows is not there, no, sir. In the
no,
videos
you don't
sent.
have. You don't have in your syllabus. No, you don't have. Only you have is
Okay.
consolidated statement of financial position, consolidated statement of profit or loss, and OCI.
Okay, sir.
Yeah. It may not be necessary to publish all of the parent company's financial statements depending on local or national regulations. That also is important. They have given a note. Now comes the group structure. See, this is a parent. Parent can own 100% stakes in one of the subsidiaries, or less than 100%, that is 80%, or 75% or 90%. No worries, they can do that. This is a parent which has a subsidiary because it has control and power, because it has 51% stakes in this. This subsidiary has 51% stakes in this. This is called the subsidiary of this. This is called the subsidiary of this. This is called the subsidiary of parent. Okay. This is the direct parent, and this cannot do the consolidation. Only P can do the consolidation. See, with this we finish the chapter number 1. Okay. Let's go for the first question of chapter number 2. We'll do the consolidation. Fine. Let's start. See, before going into this, you should first understand what are you doing here. This is a parent subsidiary. Okay. So parent invests in subsidiary. Fine. At the end of the year, they should consolidate. They should prepare a group account. So all the intercompany adjustments should be cancelled. Why it should be cancelled? Please tell me. Any one of you?
Because it is a single entity.
Yes. Why? Because
It is a single entity.
yeah, this is a person. He has one pocket to his shirt or pant. So he has 100 rupees in this pocket. So he just takes out 100 rupees and puts that 100 rupees in this pocket. So how much he has now? How much?
100.
100 or 200? I'm asking a simple question. This is Mr. A. He has 100 rupees in one of the pockets. He has put this 100 rupees from this pocket to this pocket. Just a transfer of funds.
100 rupees.
100, sir.
Yeah, because he will not have more than 100 rupees. Why? Because it is with him only. He is only holding that 100 rupees. Now, from one pocket, he is transferring the money to another pocket. So there is a shop A.
Single entity.
Yeah, there's a shop A, there's a shop B. So from this shop, they have transferred 1 lakh rupees to this shop. At the end of the year, when they club and show the like single company account, they'll show 2 lakhs or 1 lakh only.
1 lakh
1
only.
lakh.
Yeah, it's nothing but putting money from this pocket to this pocket. That's it. Okay. So intercompany transactions, they have to be cancelled out. Why? Because if they are not cancelled out, they would lead to double count. Understood? Because nothing has increased, the same thing is what they have. But let's go ahead with one example. This is a particular statement of financial position of a company, and we'll see the cancellation part. See, this is the statement, and you see that non-current assets, property, plant, and equipment are given investment in 40,000, $1 shares in S company at cost. This is the investment they did, correct? What is the entry for investment? Investment to cash. Please tell me.
Yes, sir.
Hello. What is the
Yes,
journal?
sir. Yes, sir.
Yeah, the journal entry for
Investment to cash, sir.
investment to cash. And when they prepare the balance sheet, so they have cash account. suppose 1 lakh, and they did an investment of 40,000, and the cash has got reduced from 1 lakh to 60, correct? Still
Yes,
they
sir.
have
Yes,
how, still they have how much of assets? 1 lakh only, na?
60,000.
No, 40,000 investment also they did. This is the parent company. See, parent company had a cash of 1 lakh. Out of that, 40 they used to invest. So how much cash they have right now?
1 lakh.
60, na?
60,000 cash, sir, plus
And-
investment
and
40,000.
40. Investment 40, correct? So total cash, total assets they have is still how much?
1 lakh, sir.
1 lakh, 1 lakh. Now subsidiary company. Subsidiary is capital. So for subsidiary, it is cash to capital, correct? Correct or wrong?
Yes, sir.
So how much cash they got?
1 lakh.
40. And capital is how much? Correct? Please tell me.
Yes, sir.
Is it so? So the entries are investment to cash and cash to capital. So 40,000 investment done, cash gone out 40,000, 40,000 of cash they got, and 40,000 is capital. When you show them as one company, then how?
Investment to capital.
Investment to capital. This cash and cash would go out, na? Correct?
Yes, sir.
This is not you're showing us a single company. Let me give you a good let me give you a clarity. This is a clubbed entry, not a consolidated company's entry. It is not just it is not that you're showing it as a consolidated thing. It is just cash and cash, credit and debit would cancel out. You got it? Are you following what I'm saying?
Yes, sir.
You're following, na?
Yes, sir.
Now what is happening? That when now you will consolidate. So when you consolidate, your asset should be how much completely? It should be 1 lakh or 1 lakh 40?
1 lakh, sir.
1 lakh. Why? Because from parent it has gone to subsidiary, or like at the end of the year when you consolidate the money is with the group only, na? Has it gone out? It's nothing but putting money from one pocket to another pocket. If parent has invested 40 in subsidiary, they are showing it as investment, na, here. I don't understand what's the problem. Are you people understanding? The asset is still how much? Please tell me. 1 lakh or it has increased?
1
1
lakh
lakh
only,
only.
sir.
1 lakh, sir.
It is 1 lakh only. It has not increased. So to show that as only 1 lakh, what shall we do now?
Remove the inter
Yes,
transactions, so intercompany transactions.
intercompany transaction. So what we can do is, so the investment they have shown is 40, and the capital what they have got is 40. When we show them a single company, this investment what we have done, okay, we have to cancel, and this capital we need to cancel, and this cash how much we had?
60,000, sir.
60,000.
60. And this cash how much we have now? Come on, boss, how much?
60,000 plus 40,000.
40. It is 1 lakh. That's it. You don't have more than that, na? Still cash is 1 lakh only, na, or more than that?
No, 1 lakh,
1
sir.
lakh only.
That's it.
Lakh
So,
only, sir.
yeah, still the cash is 1 lakh only. Okay. Why? Because if we take this as 1 lakh, the assets of parent as 1 lakh, and add this 40 here and add the capital there as a consolidation, it will be double count. Why? Because nothing has increased. Everything is still in the company itself. Okay. All of you, please tell me, every one of you understood this or not? Meghna and every student, please tell me.
Yes, sir.
Yes,
sir.
sir.
Meghna, you understood?
sir.
Rajesh, you understood? Everyone. Priyanka, everyone,
Yes,
na?
sir.
Yeah.
Yes, sir. Yeah.
Yeah. So this is what is the thing. So you have to cancel this and you have to cancel this. Now everything you club this, but okay. Receivables from S company is 2000 and receivables from the P company is 2000. Again, cancel out. Intercompany transactions, nothing has grown. The same goods value, whatever it is, they have that much. Okay. And because when if we consolidate now, what will happen? It will be doubled. So we should not add up those things. Okay. So whatever is between the parent and subsidiary has to be removed, or else it will create a confusion and it will be like double counting. And here the 6000 is from others and here also from others. So from others it is acceptable because the money is going to come from outside people. Okay. So this 2000 and 2000 what we are canceling is nothing but this is one pocket, this is one pocket. This is parent, this is subsidiary. So from parent 2000 has gone to subsidiary, or from subsidiary if 2000 comes to parent. So still they have 2000. Okay. And since this is not going to create any value for them, it has happened between them, it has not happened with any outsider. So in general, do they have any receivable and payable between them? All of you please tell me. See, this is shop A, shop B. Shop A has sent 10,000 goods to B. So when they are separate companies, these guys will show receivable, these guys will show payable. But when they become same company, do they have receivable, payable?
No, sir.
No, sir.
No, that's it.
No,
We
sir.
need to cancel out. Yeah. So we will just cancel this and this because these are irrelevant transactions of no use, of no sanctity. Okay. And then cash at bank is given, and then your ordinary shares of parent retained earnings you should again add up. Okay. And this one, like, it is a fully owned subsidiary, it seems. Okay. Then next, you should take the bank overdraft and you should again, like, this is cancelled out, payables you should add, and after that you'll get a statement of this form. Please all of you do that and see whether you're getting this or not. I'm giving the chance. Come on, do this consultation. All of you, after doing this, please tell me. All of you, after finishing, please tell me. I'm waiting for your call. Finish? All of you check.
Sir, 1 minute.
Yeah, all of you check your
Yes,
answers.
sir. Yes, sir.
Yeah, all of you check your answers.
Done.
Done, all of you? Yes.
Sir, 1 minute, sir.
So can you scroll down a bit, sir? Hello? No, sir, question. Okay, sir.
Done, sir.
Yeah. So all of you check this.
Done, sir.
Yeah. Let's do the one more question. See, this is like the statements of financial position of P company and of subsidiary S company have been made up to 30 June. P company has owned all the ordinary shares and 40% of loan stock of S company. How much? 40%. So what shall we do here in consolidation case? See, non-current assets you should add. Investment in S company at cost, 80,000 ordinary shares of $1 each is given. And here also 80,000 is given. So capital and investment will cancel out. Okay. $20,000 of 12% loan stock in S company. And here loan stock, how much they have given?
50,000.
50,000. So 20,000 and here 20 cancel out. So how much will be left over?
30,000.
30,000. Okay. So are you seeing the same thing? Are you seeing the same thing?
Yes,
Hello?
sir.
Yes?
Yes, sir. Yes, sir.
Then you need to add inventory, receivables, current account with S company, 18,000 they have given here. And the current account with P company is 12,000. So like they are supposed to receive, they are showing 18,000 and these guys are showing they are supposed to pay 12,000 to them. So how much they can cancel out common things? 12,000, correct?
Yes, sir.
Yes, sir.
That means 6,000 will be in transit. So that cash in transit we can say.
Yes, sir.
Yeah. Goods in transit, sorry, because it's goods, sorry, goods in transit. And cash add up. Then this is done. This you should show retained earnings add up. Loan stock, all right. Payables add up. Taxation add up. Done. This is the consolidation.
Sir, goods in transit is what, sir?
What goods in transit?
Is what, sir?
That is supposed to be received. It is on the way.
Okay.
It is on the way. Transit means on the way. Got it? Hello?
Okay, sir.
Okay. Please do this. Do the consolidation.
So 4,16,000, sir.
Sir, 5,16,000.
4,60,000.
Yes, sir.
Yeah, it's 4,16,000.
All of you finished?
Yes,
Yeah.
sir.
Okay. So till here it is all right. Tomorrow we can start with NCI. From here we will rush. Most probably it will take 2 days for us to wind up this chapter. Okay. Then we will solve some good questions on this. Okay. Fine, all of you?
Okay, sir.
Okay, sir.
Sir,
Yes, please.
sir, I'm Rajeshwari, sir.
Yes.
Sir, can you send today's recording, sir?
I will send, no problem. Yesterday's and
Yes,
today's,
sir. Okay.
both recordings I will send. Okay.
Okay, sir. Okay, sir.
I
Thank you.
also asked, sir.
I will send today after this class. This yesterday's and
Okay,
today's
sir.
both recordings, whatever the class I've taken, I will send for consolidation. Not a problem. Okay. All of you, I'll send.
Yes, sir.
Thank you, sir.
Thank you, all of you. Thank you.
Thank you, sir.
Thank you, sir.
Thank you. Thank you. Thank you.
Thank you, sir.
Thank you.